Hello, I'm Dominic Hobson, co-founder of Future of Finance. Welcome to our webinar, Whither, Digital Asset Custody. In the traditional securities markets, custody has not always enjoyed the respect which its practitioners feel it deserves. I think we have known for several years now that custody, far from being disintermediated by decentralized blockchain ledgers, is absolutely crucial to the development of the tokenized securities and fund or digital asset markets. Cryptocurrency investors have themselves discovered, not least amid the events of 2022, that independent third-party custodians, which segregate customer holdings in case the business falls over, are absolutely essential to the safety of their assets. Regulators too, noticeably in the United States, the jurisdiction from pretty much every regulatorily inspired innovation in custody has ever come, have woken up to the protection custodians can afford to investors, albeit not always in the most constructive of ways. So at Future of Finance, we've spent some time over the last year or so trying to work out what exactly is going on in the world of digital asset custody. Not just which providers, amid a choice which runs into hundreds of different firms, actually matter, but what's happening to cryptocurrency custodians in a prolonged bear market. The answer, in a word, is consolidation. We've also looked at how custodial technology vendors are adapting to more difficult market conditions, and we find they're showing a lot more interest now in selling to established banks. And those established banks are interested because the global custodian banks in particular know their existing clients would like them to do something about an asset class they, the buy side, are interested in investing in as and when it comes fully into existence at scale. But it's also an asset class which presents risks which are very different from those that custodian banks are used to managing in the securities and fund markets. And as our contribution to these various strategic reorientations, we've embarked on a long and deep investigation into what firms are doing and what regulators think all types of custodian ought to be doing. That work has, of course, made use of publicly available information, but also of the findings from a proprietary questionnaire, which is open to any digital asset custodian or custodian technology vendor interested in reaching our audience of potential clients, measuring themselves against their competitors, or just understanding better the markets which they operate in. And you'll find, if you are interested in taking part in that research exercise, you'll find the questionnaire on the homepage of our website, adjacent to the second edition of our digital asset custody guide. But today our aim is more limited. It's to review our most recent work and our findings with a group of experts, each with a distinct perspective on the issues. Marius Lunding-Smith is a Director of Strategy and Growth at Finoa, the Berlin-based crypto asset custodian licensed under the German Banking Act and regulated by the BaFin. Thilo Derenbach is Head of Sales and Business Development in Digital Securities Services at Clearstream Banking in Frankfurt. Mark Meyerfeld is Chief Revenue Officer at GK8, the cybersecurity fintech now owned by Galaxy Digital Holdings that provides an end-to-end platform to help financial institutions self-custody their digital assets securely. Tariq Rashid is a partner at international law firm Reed Smith. He specializes in advising investment banks, funds, exchanges, and custodians on both the regulatory and transactional aspects of derivatives, structured products, and crypto assets. As always, at a Future of Finance webinar, we have an audience and our panelists are eager to answer your questions as well as mine. So I encourage everybody watching or listening to submit their questions and comments throughout this webinar by using the Q&A functionality at the bottom of your Zoom screens. And again, as always, we won't be saving those questions and comments up to the end, but we will endeavor to address and answer them as we go along, which means you can be an integral part of this discussion right from the outset, and we very much encourage you to do that. But we're going to begin by drawing on the wisdom of the crowd. We invited everyone registering for today's webinar to give us their opinion on two questions highly pertinent to the future of the digital asset custody industry. And we asked the first question we put to the audience is, which interests are actually driving change in digital asset custody? We restricted this to the buy side, the end consumers of a custody product. As you can see from this slide, which gives the results, there's a pretty clear message that it's institutional money and the institutions which manage institutional money, asset owners and their asset managers and their alternative asset managers, more than 2/3 of the respondents think they are the institutions which are going to make the meaningful changes in digital asset custody over the next 5 years. What this slide says to me in particular is that if you look at the bottom of it, the retail investors and the high net worth investors, and I think had we asked about sell-side professional firms who've traded cryptocurrency over the last decade or so, they are not going to be the architects and influencers of change over the next 5 years. This market is institutionalizing from a buy-side perspective as well as a sell-side perspective. Our second question, which we put to registrants for today's webinar, was which type of digital asset custodian do we think is going to dominate the market by the end of the decade, by 2030? And here we get a very clear message that it's regulated custodian banks that are going to be the winners, if you like, of the present contest to decide who will dominate the marketplace. But the institutions which are following some distance behind regulated custodian banks, in other words, digital asset exchanges and the regulated non-bank custodians, which have emerged mainly from the cryptocurrency markets, I think this slide is also telling us that you need to be regulated. That if you're not regulated, if you look right at the bottom there, you're not going to have much of a future in this market. It might be worth just delving a little bit into where this final result comes from. And if we look at the third slide, what you can see here is that, and I think this reinforces the message of the previous slide, if you're a regulated non-bank custodian, you tend to think that your future lies, the future of digital asset custody lies with regulated non-bank custodians like yourself. 44% of the answers came from people voting for themselves. You get something a bit similar with digital asset exchanges. They too think that they have a meaningful part to play in the future. What's really interesting about the regulated custodian banks, which are the ones marked in red, is that the people voting for regulated custodian banks as the face of the future of digital asset custody are a bit more independent than those who voted for digital asset exchanges or regulated non-bank custodians. In other words, it was consultants, it was law firms, it was technology vendors, other odds and ends. I mean, you get a bit of regulated banks voting for themselves, as you can see at the top. But on the whole, I think that 58% vote for regulated custodian banks is a more reliable finding than the votes for digital asset exchanges and regulated non-bank custodians. And with that, I think brief presentation, and obviously these slides will be made available to everybody who's registered for the webinar after the fact. We can now commence our discussion, but maybe we can begin by asking our panelists what messages they're taking away from those slides. Does it surprise you that the future is so clearly institutional, both in terms of the custodian banks that will be dominating the marketplace, but also in terms of the buy-side institutions that will be driving it? Thilo, perhaps I could begin with you. I imagine that's a kind of welcome set of findings for you. But once you've given the verdict, we could talk to Mark and Marius a bit about how they interpret it.
Wonderful. Dominic, first of all, thank you very much to you and the organization for having me today. And thanks to the audience for listening. We hope we'll make it as interesting as possible for you and also entertaining, perhaps. To your question, it is, of course, it's a satisfactory sort of outcome for us as a financial market infrastructure in the traditional world. But I think it very much reflects the reality of the interaction that we have and that other market participants have with the industry players. If we look at traditional custody champions, if I may call them that, because they have decades of experience in safekeeping assets, in processing life cycle events for these assets, it is something that is, of course, of great value. They have the backbones, they have the back offices available for these sorts of activities. But I think there's also an aspect of trust and high level of regulation. You've mentioned it a couple of times, but that high level of regulation that these custody banks enjoy or endure, depending on from where you look at it, is something that is of great value in this context, because we've seen some of the negative examples of alternative solutions that have either gone belly up or have had fraud events that are, very sad and must be avoided in the future. And so it's a question of risk, trust, and level of regulation from my perspective in regards to the custodial banks. And then in regards to the buy side clients, it entirely overlaps with our experience in the context of the discussions that we have, the volume of discussions we have with buy side banks, or sorry, buy side players or asset owners, asset managers versus sell side organizations or others, is probably 75 to 25. They're very interested in these developments. They see great business opportunities, new distribution channels, whatever the dynamics may be, but they're very much driving these initiatives and looking for not only solutions, but actually value in leveraging the technologies that are available, putting existing traditional assets or native crypto assets onto the blockchain and using the benefits that are being generated there. And so something that I entirely support and sign up to. The results would play very much into what we see and experience.
Okay, well, I'll come back to the point you raised about regulation being a big part of our discussion today, I think. And also we'll need to ask some questions about what banks are actually doing. Clearly there's an appetite for them. But before we do, Mark, just perhaps you'd give us a verdict on what you think, what messages leapt off those slides to you.
Yeah, absolutely. I think it also corresponds with what we're seeing in the market. I mean, without a doubt, the institutional business, and we're seeing right now an uptake in projects around stable coins, which is going to, and the ETF world in the US, these are all lending itself to liquidity. And in order for the institutional base to really pick up in the digital asset space, it requires liquidity. So this is the first step that we're seeing going towards that. And there's no doubt that the regulated banks and the large banks, but also non-banks, are going to play a role. I mean, we're seeing it today. The banks, even in jurisdictions that don't have regulation, are very much preparing themselves for the inevitable. And what they're doing is they're installing infrastructure, whether it be in the tokenization space, whether it be in the crypto space. Some of them are doing POCs, but they're all getting to a point where they realize they need to be ready. And as soon as the regulation does come into play in certain jurisdictions that don't exist today, they want to be able to flick a switch and get into play. So I think we're definitely seeing that uptake already in the space by the banks. And of course, the exchanges and non-bank custodians are clearly going to play a role, but the regulated large banks are clearly going to be ultimately the winners, which I would agree with the poll here.
Okay, and thank you, Mark, for bringing that. We'll look at the rising appetite among non-bank custodians for getting regulated in some shape or form a bit later in this discussion. But Marius, perhaps I could bring you in at this point. What our little questionnaire and those slides told us is that there is a big institutional appetite for the regulated custodian banks to get into this business. We're also picking up in our research that more and more banks are getting into the digital asset custody business as well. So there is some kind of response to that. But on the other hand, it's not always the sort of banks you'd expect. It's not always the big global custodian banks who are the first movers in here. We see a lot of private banks, almost because they're responding to private banking clients who want to invest in cryptocurrency. So although we see this appetite and we see increasing bank activity, we're not actually seeing global custodian banks used to looking after institutional money offering a product, if you like, which is very convincing for institutional investors. It seems most of these bank offerings are still a bit of Bitcoin, bit of Ether if you really must, but I don't see massive commitment to security tokens or tokenized funds. What explains that, Marius? And does it accord with what you're seeing in the marketplace?
Yeah, I think many of the things that was also mentioned by Mark and Thilo here, I fully agree with. And I think what we've seen, say, up until today. And I think it's important to acknowledge that the crypto market and industry and technology, for that matter, is still quite nascent. And so naturally, it has been led by, say, more, say, risk-on investors. And I think from an infrastructure and regulatory perspective, that poses kind of two sets of challenges. One is that you deal with a technology that is fundamentally very new, and something that is not, say, easily to integrate with existing systems. You also have a lot of innovation happening on the, say, blockchain layer itself. So we are still very much, I think, shaping which technologies and rails we're going to use for, say, these future financial rails. That in turn, say, also puts a lot of constraints, but also poses a lot of challenges, say, operationally for actors that wants to provide services in the space. So I think that is where, let's call them non-bank custodians like Finoa have emerged, serving, say, a need that currently exists in the market that is, say, highly fragmented, where it's very difficult to find service providers that can cover all of your cryptocurrency needs from say, one place. I think simultaneously, you also seen that regulation, I think it was also mentioned, has not really been able to pick up, and there hasn't been, say, proper frameworks in place allowing, say, both existing larger banks to enter, but also for innovation to happen on the service provider level. So there are probably more than hundreds of custodians in existence today, non-bank custodians, of which some are regulated or are pursuing regulation, but it's still highly fragmented. And I think for larger banks or traditional custodians to enter the space, you kind of need to solve this technological challenge that I think is very present today still. And then also, I say, from a regulatory perspective, we need more, say, unification and better standards and frameworks that one can adhere to before we really see, say, full-blown projects and not just POCs coming about.
Right,
yeah.
we're starting to get questions coming in now. Thank you, Marius. And I'll turn to this in a second. I'd just like to give Tarek a question to give us his view on this. Tarek, are you finding yourself advising major global banking groups that are prepared to develop a digital asset custody product which covers not just cryptocurrencies, but security tokens, tokenized funds, the full gamut of digital assets? Do you see anybody developing that product yet?
Yeah, I mean, to begin with, thank you very much for having me on this webinar. You're absolutely right. We are getting tentative expressions of interest from various major institutions who are at present building capacity. I mean, good examples are BNY Mellon, JP Morgan, State Street, so on and so forth, who are building up their own ecosystems. But, you know, these are massive institutions. So the feeling we get is that there has definitely been buy-in from the major financial institutions to enter crypto assets generally and custody specifically. But it just takes time for them because they aren't as nimble as the smaller players. And of course, what they also have to take into account is the fact that they're already regulated. They're already subject to, you know, in the US, they'd be subject to various regulatory oversight, same thing in the UK, the EU, so on and so forth. So they have to take into consideration much more actively what their regulators are thinking, and also reputational risk. And finally, and I think this sometimes gets ignored, any blowback from an AML and terrorist financing perspective. So they're just slow moving. I think they'll continue picking up pace, and during the course of this year and next year, I think we'll start seeing much more public announcements from them.
Mm-hmm. Okay, I was just wondering what.
If I may,
yeah,
sorry.
Yeah, go ahead.
If I may just add, I think I agree with what Tarek said, but one of the things that we see with the large institutions, and something that we took into account probably about a year and a half ago in our platform, is you mentioned, are they going to use the same infrastructure to support tokenization and crypto assets? And one of the things we focused on is the ability to provide generic support for, as an example, generic support for smart contracts across the board, which allows really customers to work with any type of tokens. Generic support for all EVM chains. So providing them the widest coin coverage allows them to start with potentially tokenization and then move over into the crypto assets when the regulation comes into play. And even we have some of the top tier banks that, as Tarek mentioned, they don't have the ability even to hold crypto, even if they're working in a tokenization space, they can't hold crypto for the gas fees, as an example. So we have a solution that allows what we call gasless solution, where they don't have to ever have gas, Ethereum or crypto assets in there to cover the gas fees in their wallet infrastructure. So these are all things that we put into play in order to really support every level of the institution, even in the first phase of going with tokenization and then moving towards the crypto world as regulation comes into play.
Yeah, I mean, that's well put, because I right now, my understanding is that there's a lot of capacity building and understanding what is a relative competitive advantage for each of the banks. Of course, if you look at JP Morgan, I think they've gone somewhat more out through the Onyx platform than a lot of the other entities have done. A few banks even are clubbing together. You know, for example, Deutsche Bank and so on and so forth have been concentrating much more on stable coins. But yes, I'd say at this point, it's very much capacity building.
And if I may add, agreeing to all of these things, it's a lot, and I hope we will touch on this later in the webinar, it's a lot about establishing certain levels of standardization that will allow for also interoperability or consolidators, but providers of standard interfaces, leveraging capability across different asset types, across regions, across jurisdictions, as Mark, you described with your response. I think standardization as a basis for interoperability to allow for mobility of those assets across chains, custodians, whatever we want to call it. I think that's going to be super, super key for the institutional players to really get on board, because the upfront initial investment is quite high. The unit costs at the moment are extremely high compared to the volumes that we see in the institutional space. And perhaps also coming back to the questions that we've been receiving, right? If we talk about alternative assets or cryptocurrencies as specific individual asset groups, we might have different answers as to what we're discussing here, which is more to your point, Dominic, security tokens or tokenized, security tokens or tokenized securities. Right?
But let's just, I've been arguing in effect the future of this market is institutional, and that's why it needs regulated banks. But I've been corrected here by Ian Hunt, who says there are 420 million people with holdings in crypto, and saying it's all about institutional investors may be missing a big sector and a big point. The non-bank nature of crypto appears to what he calls mall investors, retail investors, and who's going to look after them. Now, I'm not sure that crypto is that big a market. It's what, 1.7 trillion, which is trivial by comparison with the global equity or global bond or global fund markets. Your point, Thilo, about lack of scale is, banks get involved with all this infrastructure. So who is going to look after you? And how many cryptocurrency custodians do we need to look after Ian's mall investors?
I think even before we get into that, I think even with retail, the regulatory trajectory of travel across the major jurisdictions, the US, the EU, the UK, APAC, so on and so forth, is regulation. So the expectation is that even if one's dealing with retail, the custodians ought to be regulated, and ideally they ought to be the usual suspects. And I think the Bitcoin ETF is a good example. It'll be interesting to see how the ETF market develops, because if the ETF market develops, there is clearly a big role custodians will play, because they're the ones who will be holding the Bitcoin. So I think even with retail, the push from the regulatory perspective is very much towards the usual regulated custodian. So I think we more or less get to the same position, regardless of the sort of investors we're looking at.
But I think the non-bank custodians get that point. One of the things I looked at ahead of this webinar was 16 jurisdictions around Europe to see who was applying for these VASP or virtual asset service provider licenses, and across those 16 jurisdictions it came as more than 2,135 to be exact, of registered VASPs. Now it's difficult to tell from that how many of them are actually interested in custody. But what is interesting is getting on for, in fact, rather more than half of them are in Poland. And in fact, if you add Lithuania to that, you're getting on for 2/3 of the total of registered VASPs in Europe are actually in these two jurisdictions. It's quite hard to tell what's really going on, and we're doing more work on that. But it does tell you the same thing as our little poll has done, which is actually the future. And what you've just said, Tarek, the future here lies with regulated institutions, not just with regulated banks. You're going to be nowhere if you're not regulated by somebody somewhere. And I guess my question here is, how is a buyer of these services meant to choose between? I mean, what are the merits of being registered as a VASP in Poland as opposed to being, registered bank with the OCC and the Federal Reserve in the United States?
I think it goes to also what's behind it. In other words, yeah, you can go to Poland and spend a very small amount of money, and in a very short period of time, you can have a license. But really, I think when you're talking about people investing or putting their money in institutions, they have to understand really what's been enforced over there. So if you're doing custody and you're storing your assets in a hot wallet, okay, on the internet, then okay, you're not going to have security. You need to have it in a proper offline cold device, disconnected. You need to have proper insurance and governance and policies built into the solution. So there's a lot more than just having the piece of paper saying I've got license, but there's got to be a lot more to it that's built as part of the overall governance. And that's where institutions that have reputation are going to come into play as well. I mean, there are more than 25,000 banks globally. All of them are storing fiat in some way, shape, or forms today. And I mean, ultimately, and then you've got the non-banks on top of that. There's going to be plenty of players playing in the custody space. And yeah, I mean, every license is going to be in of itself different, but you got to look at what's really the institution is using to secure the assets.
And
before we get into
the
regulatory thing, Thilo, perhaps you could just, and Thilo, you could address this question from Peter Christmas, really, which is, he says, would the picture change if we drill down into asset types? In other words, we're talking about private equity and real estate-based digital assets. Would we still be talking about custodian banks? There's been a lot of emphasis on these privately managed assets, real estate, these intrinsically liquid asset classes which don't have much infrastructure behind them. This is the right starting point for tokenization, all the rest of it. I see a lot of activity on digital asset exchanges, but not that much interest on the part of custodians.
Yeah, indeed. And I'll answer that question, and perhaps I'll also touch on Henry Ration. Good to see you here, right, Henry Ration's question in regards to the benefits. Why are we even discussing this topic? And I think when we look at mainstream sort of security tokens or tokenized securities versus cryptocurrencies, alternative assets, real estate elements, and so forth, I think we would get a different question to your point, Peter. I think that's what you're suggesting. I would support that. Why is that so? Because the level of efficiency gain for those different asset classes is different. The volumes are different, and the players that have key expertise in these is going to be slightly different. That is my view. For overall, though, we have to ask the question that Henry's rightly putting in front of us: what are the institutions actually looking for in tokenized assets? What are the sorts of efficiency gains, new business opportunities, so on and so forth, that effectively allow us to move into the space and scale, to your point, Dominic? And that's the important piece. We will see the speed of adoption is basically what I'm saying. The speed of adoption will very much depend on the one hand side, the level of standards and interoperability, and the effects, positive in terms of savings or business opportunities we can generate in these asset classes. And they will depend on the type of asset class, the players in that space, but more broadly, generally, on the question of whether we need a new technology to achieve those benefits, or whether, to your point, Henry, electronic assets could equally reach those benefits without forcing the market into a new tech stack. That's a question I will not answer all by myself. We're just here to debate that. But I think those are key elements that we need to discuss. And I hope, Peter, that answers a little bit your question. Depending on those answers, the players will be very different.
Mm-hmm. Well, we don't want to get into a discussion about what will make tokenization work, but that's a whole subject in itself. But it's clearly essential to provide an adequate, scalable business for regulated custodian banks to get involved with. And we've touched upon the obstacles to this actually happening. Among them, you raised TILO interoperability. But let's think a bit about this regulatory uncertainty question. And even where regulation is being put in place, we see different national implementations, even of the same regulation. I'm thinking here particularly of the anti-money laundering regime of FATF, for example. At the national level, they seem to be, implemented differently. So there is and maybe Marius, you have some observations to share on this as well. Just thinking about legal and regulatory issues in general, and thinking back to our poll, not regulated, you don't have a future here. What do you think is really going through the minds of all those banks and non-banks that are toying with the idea of making a major commitment to this marketplace? Is legal and regulatory uncertainty, are they waiting for that to happen, or are they starting to map out a strategy which is credible now?
Very good question. I think there's two components to that. I think if you take the investor perspective to begin with today, and you try to navigate this landscape, and I think Miles mentioned it a little bit, but in working with custodians, for instance, and in determining, who's an adequate provider for your needs, it is pretty difficult, or has been pretty difficult, to understand the, say, regulatory nuances that exist globally today. So if you go to the US, if you go to Germany, or if you go to Singapore, other jurisdictions, there might be very different requirements for what it means to be operating this business. And that is something that can be very difficult to comprehend. And I think to a point now, we are in a world where regulation is still, say, highly fragmented, which means that if you're, as a larger institution thinking about a global play in this space, there is a lot of nuances that you have to navigate. That can be regulatory diversification, that can be, finding a setup that can be broadly applicable. I think today we are still not there where it would be very easy to go out and set up, say, a fully global business. So there's a degree of, say, maturity that the industry needs to reach from a regulatory perspective, and there is more frameworks for what it means to be, say, a service provider in this business, for instance, that needs to be better defined. Because as of today, if you look at, say, what it means to be a qualified custodian in the US, for instance, that might be very different in that of Germany. There are, say, some high-level guidelines that you can follow, but there's a lot of nuances and details that are not necessarily easily understood. So I think, to sum that up, we're still not there where it's easy to kind of put out a strategy, but I definitely think that there is a active thoughts on how to kind of best set up operations to support a global crypto play in a scalable way.
Yeah, and to build on that, I agree completely what you've said, Marcus. It's also that different jurisdictions have a different level of enthusiasm for crypto. I mean, right now in the US, the mood is at best ambivalent, as opposed to what you see in the Middle East or indeed APAC. So, I've got full sympathy for a lot of entities that are trying to come up with a global offering. I think it's very difficult, if not impossible, to do that at present, which I think is very frustrating, because crypto by nature is a 24/7, 365 day sort of a business. And that's how investors also look at the asset class.
Can we, Tarek, be specific about the US? You describe the regulatory attitude there as ambivalent. I think that's rather generous. I think most people actually as being somewhat hostile at this point.
Yeah.
People listening, just let me remind them what's happened there. And in custody terms, there's no jurisdiction more important than the United States. You know, through ERISA and through the 1940 Mutual Fund Act, it has been an enormously influential force around the world in shaping how custody works, where the money comes from, but it's also the regulation shapes how that money is custodied. And what we have now is decisions by the SEC and by the Office of the Comptroller of the Currency, the OCC, which are pretty hostile to digital assets. So we've got SAB 121, this staff paper from the SEC, obliges holders of custodial assets, digital assets, to recognize those assets on the balance sheet, both sides, both the asset and the liability side. But that is a whole new departure in custody, which is traditionally an off-balance sheet business. Then you've got the SEC putting forward this safeguarding rule through these revisions to the 1940 Investment Advisors Act, which has led to an unprecedented coalition of hostility against the measure from virtually every financial institution and financial trade association you can think of, because it threatens to undermine how banks fund themselves and indeed to widen custodian liabilities beyond the point at which they can reasonably be held responsible for what happens to customer assets. Now, on top of that, you've got the OCC refusing, national trust bank licenses, custodian bank licenses, to even the most respectable of the institutions which have emerged from the cryptocurrency industry. And I wonder, Tarek, how important are these measures, these decisions, in discouraging the global custodian banks from making a full commitment to digital asset custody?
Yeah, they're extremely discouraging. I mean, we have a number of clients who would much rather come up with offerings outside the US, in other words, not touch US persons, and just wait and see what happens in the US. If you look at SAB 121, that contradicts outright the proposed safeguarding rule. There's a lot of interagency arguments clearly between the SEC and the CFTC. Very fundamental questions about what crypto is. Courts are playing a cameo role as well. There's even been talk about Ether being viewed as a security. There doesn't seem to be enough of a push to come up with an overarching legislative approach along the lines of what we've seen in the EU. And all of this just means that as far as crypto is concerned, a lot of the innovative developments could very well happen in other jurisdictions, with then people just hoping that the approach in the US calms down. Also, what I've heard a number of clients speak about is whether the manner by which the US ends up reconciling with crypto is actually going to be more through international standards, through the BCBS, FATF, BIS, so on and so forth. So as crypto matures, especially the custodial offerings mature globally, and we've got international standards, at that point, maybe the US picks up a more positive approach towards crypto.
And we don't have that level. Sorry, go on, Mark. No, please.
No, go ahead. Back there.
And we don't have that level of standardization across the regulations. But to be fair, or luckily, both in Europe and in Asia, regulators in the domestic market have not waited and have pushed forward with actually very comprehensive regulations, be it in Luxembourg and Switzerland, in Germany, and of course in the Asian markets as well, for crypto, but also for digital and tokenized other assets, which is very, very good. But to your point, the level of harmonization and standardization across those regulations, even in Europe, doesn't exist yet. We have the pilot regime, that's nice. MiCA will be a real milestone from a crypto perspective.
Yeah.
But indeed, more harmonization, even EU-wide across the Asian markets, and of course in the US, would be very, very welcome, particularly for the large institutions that you've mentioned earlier.
Yes, of course. But I think just jumping in, I think harmonization across such a nascent asset class is going to take years, if not a number of decades. If you look at securities, for example, that's taken, decades upon decades. Same thing with derivatives. It's taken a financial crisis for the G20 commitments to show up. So I think from a regulatory perspective, there will continue to be a heavy amount of fragmentation. I think MyCar is interesting because at least it's an ambitious pan-EU approach, which then shows, other jurisdictions how to approach regulation. So I think MyCar will be. I think
Eric, it excludes security tokens, which is the big opportunity for our friends here.
Precisely, and I think I've got sympathy as to the approach MyCar has taken and keeping security tokens within the ambit of MiFID II, because at least we know how MiFID II behaves. So it's to the extent that a person's dealing with security tokens, I would argue that a person dealing with security tokens is in a somewhat better place, knowing what to expect under MiFID II, whereas MyCar is pretty untested.
But does MyCar then give the national jurisdictions an advantage? They can make up what they like within the constraints of MiFID to attract digital asset custody business. And Thilo will have some observations to make on this, what's happening in Germany. I hope he'll tell us everything about Germany in a minute. But Mark, before we leave the United States, you, I'm sure, have some views on.
Absolutely. I mean, obviously the current administration is quite hostile to digital assets. That's a given. I think the Bitcoin ETF was sort of forced upon Gensler to some extent, and that got approved, which is great. But I think the overall feeling is that under the current administration, which it comes up in November for new elections, is going to be a struggle, I think, for most of this year. But with that said, we are seeing even the U.S. banks, the global ones and even the non-global ones, are still realizing that even if it's a year away or a year and a half away from being regulated, they move very slowly, and they need to get into place the infrastructure and the solutions in order to be ready when it does actually come into play. And I think everybody does realize it is a matter of time. The U.S. market can't be in a scenario where they're not providing regulation around the digital asset space. I think, and that's a realization. The question is just the timing of this. Now, from a fragmentation, I mean, somebody used the word harmonization across different regulatory jurisdictions. I mean, clearly it's going to be a long time before we have a single regulation on the global sense. But what we are seeing is we're seeing a lot of different jurisdictions picking up, and I'll use the word copycat, other jurisdictions. I mean, if you look at Turkey is a good example where regulation was supposed to go into play probably about a year ago. It still hasn't been announced just yet. I think everybody's anticipating it shortly. They took a lot of the requirements from places like Thailand and the UAE, for instance, having all the key material within the country itself, having physical on-premise installations. These are all things that a lot of the existing regulations are trying to copy what succeeded in this. And I think you're going to see more of that over time over here.
So Ian Hunter's asked a very interesting and important question here, which I'm going to come to in a minute. But let's finish talking about the regulatory scene in Europe. And Thilo, Germany has carved out actually a rather progressive role for itself at the national level. It's passed its Electronic Securities Act. Under that act, by a very complex legal process, it has created things which actually work. You can register as a digital asset custodian. It's created a registration function for electronic securities. It has also even started to inspire activity. We've got, I think, the last count I saw was 62 security token issues, and thousands of these digitized securities, which are being lodged with D7, which is part of the Clearstream empire. So things are actually happening in Germany, possibly not in quite as revolutionary a fashion as you might think, particularly those thousands of securities I referred to a minute ago. But can you explain to us what is happening in Germany and why it's interesting if you're in the custody business?
Yeah, I will. Very happy to. And I'll do a little bit of marketing for your organization because you've put out this digital asset custody guide in a new edition, looking at the German market specifically, but it's actually quite comprehensive, also looking at the European developments and outside. I won't repeat what's in the guide, and perhaps others have further comments. So in the German market, or if I go back to my sentence earlier, there are very comprehensive domestic regulations available in a number of European markets, such as Switzerland, Luxembourg, and, as you rightly state, in Germany with the E-Securities Act, the EWPG, das Wertpapiergesetz. And these are very comprehensive for the participants that are looking to establish themselves as crypto and tokenization platforms in those markets. And I think they've all been able to attract a very relevant level of interest and activity. You have the HSBC's Orion in Luxembourg, just to name one. There are many others. We have our D7 platform in the German market. You have SDX in the Swiss market. So back to the point that Tarek was making, the regulatory environment and framework is important as a base foundation, basically, to attract institutions to play a role. And for the German market specifically, just to say 2 or 3 words on this, you mentioned crypto assets in the tens that have been issued, worth I think just under 200 million euros now. The assets that have been tokenized under the E-Securities Act in Germany, versus the in the meantime 12,000 digital security issuances worth north of 3.5 billion euros already. So just to put that into perspective, but also in larger context of the 1.7 trillion in the cryptocurrency space. But the regulations are foundations to build on, very fundamentally important. And in this context, we then see for the German market, for example, that these allow for the growth of the markets. They don't scale at a level of a hockey stick yet, but the volumes are rising because more participants, many new players, new entrants in the market actually are leveraging these regulatory frameworks to provide their products and services, which is quite important. I'm not going to dwell too much more on that, but I think the German market is a good example. The Luxembourg or the Swiss market could be others, to clarify and showcase why the regulatory foundations are so important to actually get these instruments off the ground.
Am I not right, Thilo, to think that actually what's happening in Germany also displays the limitations of tokenization so far? Thousands of issues.
Absolutely.
Might digitize the issuance process, but they don't digitize anything else. The entire paraphernalia of intermediaries and service providers continues to exist. So we're not yet reaching the world described by Henry Raschen, in which efficiency is transformed and operational risk goes down and capital allocation.
I'm not, Henry and I, we know each other, but I'm not going to defend him specifically. But at a unit level, we very much can evidence those effects, very much so. And every one of the platforms, be they the traditional ones issuing digital securities like ours, or those actually creating real tokens, at a unit level, all those effects are real. They just don't add up to a business case. Right? So the lack of scale means that the unit benefits don't add up to something relevant enough yet, right, for market participants to really push into those segments. I hope that the colleagues agree with that, or please contradict me, but that is the main point that I would have.
Marius,
one of the things that you mentioned. Sorry, okay.
Marius, why don't you give us a thought about Germany, if you have one?
Yeah, I think I would very much allude to what Tito said here. I think contrary to what people normally associate with Germany, they have been, and the German regulators, very proactive in regulating the space. And I say that coming from Denmark, where there has been very little developments. So back in 2020, it's a very comprehensive frameworks were rolled out, and I would say the barriers to entry have been high, and say for custody specifically, we're now up to, I think, nine participants totally. But it also means that the quality of the entrants and participants is usually very high. And I think that's also what Thilo mentioned here. I think we've seen some very interesting projects come out of, having these frameworks in place that are of both a very interesting quality, but I think also is allowed to operate in a way and through a framework that is, much easily understood than other jurisdictions. So in that sense, it's moving perhaps a little bit slower sometimes, but at least the projects that arise and the innovation that we see is solid and very firm. So maybe just one comment there.
Tarek, I think this is a question for you from Dan Feeney about, I don't know whether you've seen it, about the regular reserves, but whether you want to look at that before you look at that question about the cash reserving. Perhaps you could look at that while we ask Mark to. You were trying to chip in there, Mark, on the question about Germany.
Yeah. Absolutely. Yeah. I mean, obviously we announced the Galaxy GK announced the partnership with DWS in Germany. And one of the big things, which I believe is probably a use case that has real merit to it, is the stablecoin. This is going to be a Euro stablecoin, but we're involved in a number of stablecoin projects around the world. And obviously the big benefit for that is obviously settlement. And the huge value proposition when it comes to, if you're doing it properly, to have instant settlement as opposed to a T+1 or T+2, depending on where you are, has tremendous business case. A lot more than just the typical crypto assets in the world. I mean, the amount of foreign exchange traded on a daily basis dwarfs in comparison to anything in the crypto space. So I think you are going to see slowly but surely use cases with the value associated with it. And we're seeing a start with that.
Tarek, are you
But
ready?
it's not the holy grail. That will be my only statement.
Tarek,
yeah, I think you. Sorry, I can't see the question. Could you just run that past me?
He's it's in the Q&A there, and he's saying that the percentage of reserves which of fiat cash you have to keep as on the asset side of the balance sheet against your liability is 12.5 times what regular reserving is, and he's citing here, in fact, some guidance issued by Reed Smith in the United States, is proving a kind of SEC risk aversion here. I wasn't quite sure what Dan was driving at, but he has drawn our attention to this release from Reed Smith. Perhaps you should look at that while we talk about Ian's question, which is really a good point to end, as we're into our last 10 minutes now. And Ian asked this question: what is the major custodial business model here? Is it just about private key management, in which case why would it matter what the asset is? Is it holding tokens themselves on behalf of clients? Then that doesn't undermine the idea. Doesn't that undermine the idea of a self-maintaining register, which is a major benefit of fund tokenization? And I'm thinking here, we're talking about custody, and at the moment there isn't a single model available. We see non-bank custodians, for example, taking out insurance policies. We see them getting very enthusiastic about taking out these professional certifications, these SOC 1 and SOC 2, these ISA 3000, 3402 certificates, in a clear effort to make themselves more appealing to institutional money. We also see them adopting, processes and procedures very familiar from the global custody industry, like asset segregation and so on. But do we have is a single model of asset safety visible yet? Do we think? Thilo, I don't know whether you feel we're getting to that point where both regulated banks and non-regulated custodians and regulated non-bank custodians are kind of converging on a single proposition, which an institutional investor can look at it and say, well, I'll choose that provider rather than that one, because there isn't really a huge distinction in terms of the product that they're offering. Are we getting standardization of product offerings yet?
I think we're not even at a level where we have a broad range of well-regulated and trusted networks, let alone then products and services on top of those. I would start first with the network availability here, whether you make, buy, or partner. I think is less of a question. It's more the question of security. There was mentioned earlier in one of the questions. The question of security is particularly important, and competing on those aspects amongst the providers that exist today and the future ones that will enter the market, I think is not a good idea. It would rather have to be, in my view, competing on products and services on these platforms and in these ecosystems. And as we're not even at that first stage yet, from my perspective, at institutional grade levels, I would say we need to focus on those aspects first, and then the question is indeed, is it key custody that we need to focus on? And in my view, yes, in the coming years, coming from later this year, people will realize that key custody is probably the element of importance that we need to focus on. But that's my private business view. And then from there, continue on with products and services, be it collateral management services, lending services, mobilization services of assets on different chains and across ecosystems. I'll stop there because those people who actually have existing and already running blockchain solutions might have this or a different view here on the panel.
Yeah, I mean, no doubt. I mean, key management. I mean, you use the word key management. Those are the building blocks it has to start with in order to build any level of an infrastructure. And it doesn't matter whether we're tokenizing crypto assets or securities or whatever it may be. You still have to manage the keys. Yes, there are different benefits or different items that you can do when it comes to a security token, potentially like revoking and doing things like that. But there are still very important things that need to be done with the smart contract, holding the admin key of the smart contract in a secure place, because that has superpowers that can really cause a lot of damage. So it really does come down to the core of key management. And I would agree, there are definitely no standards in the market just yet. I mean, people sometimes go to the hot word in the market. So there's a term MPC, which is a technology that's being used. It's a warm wallet aspect. I've heard people call it cold, but it's warm. It's connected to the internet. So you can't eliminate risk. And people think that's secure when it's connected to the internet. But and we believe that you have to have an offline cold solution completely disconnected to eliminate risk. But there are clearly not enough standards in the market that have been coming through. But it clearly comes down to key management. Insurance, of course, is something we have the largest insurance available in the market. But again, that's just an added piece of having the proper key management. And that's how you can access that kind of a level of insurance.
Marius, I guess the real question Ian is driving at is, who's really on the line for customer assets in a futuristic, fully tokenized universe?
I think two comments here. I think to Thilo's point, I think we're still not in a place where there is harmonization across private key management standards and what it means to operate a qualified custody or fully regulated custody platform. I think those standards still have to be defined. We are seeing some, say, certificates being thrown around, and I think different insurance policies as well, with various different types of coverage and premiums, etc., that, say, for an investor can be a little bit tough to navigate. So I think there we still have a lot of way to go. And second point, I think, is that a lot of the business, say, once we solve kind of the challenge that we have now with the infrastructure and the private key management, is exactly what type of services and products you build on top of that, say, custody solution. So how do you enable participation in all these different use cases on chain? How do you do that in a secure, regulatory compliant manner? And what are the, say, products and services that you avail? Be that, say, tokenization of different assets, leveraging different rails. And I think Thilo mentioned that here as well. Even on kind of the blockchain rail side, we're still defining the standards, right, and figuring out, where do we, what technologies do you want to use to kind of send these assets from one place to the other. So there's a lot of work to be done there, and I think for custodians generally, kind of the challenge lies there in being nimble and efficient, having, say, security top of mind, but then also enabling access to all these innovative use cases that we'll see on kind of the blockchain native side. And then in addition to that, I think also managing or being able to kind of bridge that with, say, the traditional world, so to say, and offering, say, more of a comprehensive user experience where you have the ability to move seamlessly between fiat, crypto, but then also being able to participate in the relevant use cases that are on chain. And I think that is where you'll see custodians differentiating themselves. And I think where competition will also happen to a large extent once we see kind of the basis points for custody piece compressing and going down to what we know from traditional custody business today.
Thank you, Marius. Tarek, are you ready to address Dan's question? I think I see he's SAB 121 here and saying the SEC has issued advice that if you're holding these cryptocurrencies on your balance sheet, you're going to have to allocate not just 1-to-1, but 12.5 times to 1.
That's absolutely right. That's actually coming from the Basel standards. So it's not something which just the SEC is doing. Generally speaking, right now, BCBS has taken a pretty punitive approach with respect to the regulatory capital charge of transacting in crypto related transactions. So it's 1,250%. So it's extremely punitive, which just goes to show what a conservative viewpoint from a regulatory capital perspective BCBS is taking. Now, would I expect this to change in the fullness of time? Absolutely. I think as people understand operational market, counterparty risk, one would expect this to go down. But I don't think it's just with respect to the SEC. This is very much a global approach.
Okay, thanks.
Yeah.
I hope that answers your question, Dan. Our time is up now, but I'd like to give each of you just a chance to say one final thing, which I suppose is it's kind of up to you what you want to say. But my thought process is, do we have a clear understanding now of what to follow up Dan's point and Tarek's answer? Do we have a clear understanding now of what the new risks are with digital assets, and are we evolving a model which is equipped to manage the liabilities that those represent, both in terms of capital, but also in terms of the internal processes and procedures and methodologies that custodians of all stripes use to protect customer assets? Is the future coming clearly into view now, or are we still a long way off? Mark, do you feel confident we have the future within our grasp very clearly?
Absolutely. I think we know what needs to be done. And I think we're seeing that from the banks and the financial institutions having a proper security. I mean, even BaFin announced something today with regard to cybersecurity as being really the linchpin and being the most important thing that needs to be handled. So it does come back to the managing the private keys in the most efficient way, because we can't afford any level of risk. I mean, you see what's gone on over the last 2 years. And I think people have learned from that, whether it be having it properly regulated, having the proper security measures and governance and policies built into the systems. And it has to be easy for somebody to use ultimately. So it's great to have security, which is important, but you also need the usability aspect. So I think there's still the implementation pieces, the devil's in the detail ultimately, but I think the people have the roadmap and know what needs to be done. The key is now pushing forward and getting it done.
Marius, a final thought from you. Are the bank custodians, non-bank custodians, regulators, asset managers, end investors all pushing towards a single vision of what digital asset custody will be like by 2030?
No, I don't think we are fully there yet. I think
yes, no, that 12-50%.
There is a lot of different, I think, opinions forming of what the total custody marketplace will look like. I think we'll definitely see some consolidation, and I think we will also see entrance of some of the larger custodians. But I think it was Tariq that mentioned as well, we will probably see coexistence of, say, more traditional firms coming into the space, but also crypto natives, or let's say non-bank custodians coming into the space that will seek to operate, that will seek to be at the forefront of innovation. And I think at least in the next 10 years, we will kind of have coexistence there, where there will be so much innovation on the blockchain level as well, that it's going to be difficult for larger institutions to keep up. So I think if we say the 10 years is the near term, and then 2050, perhaps the world looks different then. But I think we are still operating in a very young industry, where standards are still taking shape, and where service providers still have to kind of find their footing together with regulators, private key management, and an operational complexity that comes with operating this type of business.
Tariq, I see you need to go. A last word from you.
Yeah, I think I would agree with Marcus that I think we still have a long way to go. I think one of the issues rather from a legal perspective, which we haven't really touched upon, is also parties understanding what rights they have. With FTX, we've seen issues. It's about understanding how segregation models work. And I think for that, we just need more time on the road.
Thilo, last, it falls to you to...
All right. On a positive note, financial markets are very, very clearly going digital, and tokenization or blockchain solutions are firmly part of that answer, mixed to that answer that we're looking to present to the market to deliver the efficiencies and the benefits that the technology delivers. One thing that we still grapple with and that we need to resolve as an industry are the number of use cases that are really interesting and encouraging, but don't yet stack up to business cases, and we need to work on that. And the two dimensions, in my opinion, that will support the drive towards better business cases are the themes that we mentioned: standardization and interoperability, and increased regulation, not more regulation, but harmonized and comprehensive regulation across the globe available to the market participants that will, as a derivative, deliver the security that we need in that space. So that's my closing remark. I think we're on a good track. The investments are being made. It's still a journey. It's more marathon than a sprint, but I think we're well into that marathon already.
I've certainly been very struck. Thank you for those closing remarks, too. I've been very struck during this entire conversation how difficult it is to contain a discussion about digital asset custody to digital asset custody. There are so many other influences over what will shape its future. But we must stop there. I'd like to thank our panelists, Marius Lunding-Smith from Finoa, Thilo Derenbach from Clearstream, Mark Meyerfelt from GK8, and of course Tariq Rashid from Reed Smith. Here at Future of Finance, our next webinar will take place at the same time, same place on the Thursday, the 22nd of February, a little under a month away. In it, we'll be exploring the case for further consolidation of European central securities depositories, which I know that Thilo in particular will do. And that is looking at that as a contribution to the creation of a deeper and more liquid European capital market. And I hope lots of you will be able to join us then. But for now, it's goodbye from the five of us. Goodbye.
Thank you. Thank you.